Welcome to Buffeting, the podcast where my wife Kass
Ew.
and I share our conversations on investing with you as we try to keep compounding capital so I don't have to go back to being a carpenter.
And I don't have to go back working with real estate agents. We hope you find it informative and entertaining.
But we are not your financial advisors and nothing we say should be taken as investment advice. As always, do your own research, which is more fun.
And now, without further ado, on to the episode.
Look at the S&P over the last 6 months. Look at the NASDAQ over the last 6 months. And look at the 30-year bond rate over the last 6 months. These things, it's a controlled demolition. Until inflation comes down, the demolition will continue. There's a lot of more important things in the world than money, that's for sure. And I do think it's good to remember that. And remembering that makes you a better investor.
I don't think it's helpful to watch market news at all. I don't think it's helpful at all.
No. So what do you mean by market news, do you think?
Like watching mainstream news
CNBC,
yeah, CNBC,
Twitter,
Fox,
yeah.
Even Twitter.
Yeah.
Well, Twitter's hard because it's kind of like you have some really good content, unique perspectives, and quite like you can get really good information through it, but
True.
There's also like a sprinkling of disorientating stories that like weave through your feed, even from people who you don't even follow.
Exactly, yeah.
And it always leads you off into like these little tangents and wastes your time.
I know. It's a very hard thing to balance, Twitter, as far as its like usefulness to investing, because I feel like I have had some good arguments thrown at me that I never would have come across from reading them on Twitter.
Yeah.
You know, things that I saw and I was like, oh, if that's true, then a massive amount of our money is at risk. So I'm going to research that perspective. But I think, yeah, for the most part, it just stresses you out. It's a waste of time.
It stresses me out.
Well, I think it stresses everybody out. That's why they react to it. I think that's why it's so popular.
Yeah.
Is that you read something that's like against your point of view usually, or with your point of view, and it kind of gets an emotional response going. So it creates like a chemical addiction to it, you know, like it's pretty, yeah. But like you said, probably quite unhelpful.
It can distract you and waste a lot of time and make you more emotional. So for the past 2 months, I've just not really... I just listen to what the Fed releases.
And what I say.
And I'm like, what's happening today? And checking the 30-year yield. That's it.
Yeah,
just
fair
like
enough.
Staying in reality.
Yeah. And there's nothing wrong with just doing that because those are the key factors. So if you're trying to make a decision, you want to pay, I think, the most attention you can to the specific factors that are just important. And the specific factors to our bond short, like that was always just about the supply and demand of the bond market. And why is that changing? It's changing because the Fed wants to stop stimulating the economy and start restricting the economy. And the only way they can do that is by raising interest rates. But everyone focuses on the first half of the interest rates, the short-term interest rates, the federal funds rate, and doesn't really think so much about the tightening effect that will come from longer-term rates being higher. So, yeah, like you've basically just been paying attention to what's the yield doing, because if the yield moves in a very bizarre way, then something may have changed, and we have to check it. So that in that sense, the price is kind of useful. But apart from that, yeah, what J Powell's saying,
And what CPI is.
and what CPI is, and whatever nonsense I talked to you about. But
And whatever general economic activity is happening. Like
yeah,
watching
exactly.
normal news.
And observing what we see in day-to-day life as well.
Yeah. It's just way more helpful.
Yeah. And like, look at Buffett. He didn't work in New York City because he didn't want to be exposed to all of the activity.
Yeah.
Like John Templeton, you know, he reckons their performance improved when he moved the whole fund to like, I think it was Bermuda or some, you know, Caribbean country, you know, because they got the, you know, Wall Street Journal one day later than everybody else. So they actually, he says that by getting the news after everybody else, that actually helped his investing. So all these investors, like I reckon that most people have the idea that these people are just like totally rational the whole time. But I think that they know they're actually irrational, and they then take steps to help to control their emotions. Yeah, that combined with as much peace and quiet and calm in your regular life will definitely help you to make good decisions. That's for sure.
Yeah, that's for sure. But it's annoying when you do check in with market news and it's like, what are you people doing?
I know.
It's so emotional. It's either a boom or a bust. It's like, what week is it? Every fortnight sentiment changes.
I know.
It's exhausting because now that we've just like listened to Powell's speech, it's so clear that inflation's getting worse.
Yep.
Actually, it took them by surprise.
Yeah.
And they've just moved 75 basis points. That was enough to cause mass hysteria at just the talk of it.
A few days ago. Yeah.
A month ago.
Yeah.
Last meeting. It's like, oh, he took it off the table. Everyone was so relieved. God, he took it off the table.
What a relief. The market boomed.
And he just raised 75 today, people.
Yep.
And it's like, buy the dip.
It's good news, is it? You're like, how does that make any sense?
Inflation's bad. They're going to be raising for a while.
I have absolutely no idea how bad inflation is going to get. I have absolutely no number. Like, everyone seems to have a number. That's what I find hilarious, is everyone has an idea that, oh yeah, like it's going to come down to 4, or like it might get to 6, but no, whatever. Like,
how are you calculating that exactly?
Only thing we know, or only thing that I know from our research, is that every historical inflation that's been over 5%, and I've seen like data that's been aggregated, so I actually don't know how many inflations that includes, but I've heard Druckenmiller repeat this, I've heard Bridgewater repeat this, I've heard Paul Tudor-Jones repeat it, I think, as well. All these people repeat this same thing, that when you get an economy that's having inflation over 5%, to stop that inflation, you need to get the base interest rate in the economy above the rate of inflation. So for 5%, that would be 5.5%, 6%. We know that the historical examples, like in the late 80s with Volcker, meant that inflation was 15, and he pushed the rate to 20.
Early 80s.
Late 70s, early 80s in that period.
Yeah.
So thinking about, when's inflation going to come down by itself? Historically, it hasn't come down by itself.
No.
It's kept getting worse and worse and worse. And what fuels it is a combination of, pushing money into the financial markets and pushing money into the economy, and government's deficit spending, essentially, which is creating money, borrowing to increase the amount of money that goes in the economy. So those are the factors. That's the way it's been historically. And I don't know. I think less about when's it going to come down by itself, and how bad is it going to get for them to have to push rates above it to actually force it down, because maybe those other factors, like the amount of debt we have and all that kind of stuff, the other unusual factors of our time, maybe that will play a big part in inflation coming down by itself. But there's no historical reason to think that. Open to arguments, but that's not what's happened historically.
They've just spent so far into the future. I feel like they've filled our whole economy up with liquidity, and they're having to draw it back out because there's too much out there.
Yeah.
And while there's so much out there, the little supply they have is going to get bidded up in price, because demand is just the amount of money
Exactly
people
right.
have access to.
Exactly.
That's the demand that they will have.
Yeah.
And so you need to bring that liquidity back out. So that's like wealth destruction.
Definitely.
I think people struggle to make the jump from, well, honestly, how does the Fed, making it cheaper for banks to lend, how does that affect the price of bread?
Exactly.
They find it difficult to make that jump. But if you just think of money as a demand energy output or something, like if you link the two, as simple as that, like all of that money is just demand, whether it's in housing or it's in stocks or it's in cash in the bank or in gold or in Bitcoin and crypto. It's all just can be liquidified back to money and be spent in the economy.
Exactly
it's all
right.
potential demand, and that's what needs to be drawn back out.
And that's the only way. So, raising interest rates and reducing the value of stocks and bonds, that changes the total pool of demand that's still out there to go into the real economy. So that's where the quantitative tightening and the raising of long-term and middle range rates, 10 to 30 years, which affect mortgages and all those kind of things, that's where that makes sense. But the pool of money, on banks' balance sheets, in people's bank accounts, companies that drew, who borrowed a huge amount of money at 1%, like MicroStrategies, for example, they were asking that guy, like, how's your balance sheet going, buddy? And he goes, great, we borrowed $2 billion at like 1.5%, something like that. So that's the kind of effect. If you're wondering why Bitcoin price has gone up and how that links to the Federal Reserve, well, did the Federal Reserve cause interest rates to go down to 1.5%? Yes. Did that mean that Michael Saylor, lightning eyes, could borrow?
He's fully electrified now.
He's fully electrified now.
It's like an electric chair. Yeah.
The more Bitcoin goes down, the sparklery his photo gets. But yeah, that meant that he could borrow $1.5 billion and buy Bitcoin and lever up his balance sheet. So he's so against the US government, but he wasn't against taking the low interest rate. So direct link between
everything has a direct link. You've still got the supply side causing problems. Like the Fed's just realizing now that China's supply is not going to magically come back to normal, and like the price of energy is not going to magically come back to normal.
Yeah.
And the price of food is not going to magically come back to normal. Like, there's a lot of factors making that worse.
Of course, yeah.
As well. So your supply is still restricted.
Big time.
So you've got to pull the demand out.
Otherwise, as Jay Powell said in the press conference, people use CPI to judge their future expectations of inflation. People's future expectations of inflation influences how much they ask for as a pay rise. So it doesn't matter whether CPI is, because of energy prices or because of Putin or whatever. People just see stuff going up in price, and that changes their future assumptions about how much they should be asking for and pushing for in prices. So that's the wage price spiral that everyone's always talking about. And it's already happening. You can see it happening.
That's always been the biggest danger.
Yeah. Wages and services and things you're generating in your own economy. It's one thing to be having to pay more for things that are coming from outside your economy because the whole world has too much demand. Right? That's why those things are going up in price, because the whole world is overextended. It's not just America. Like, we focus on America because our bond short is in that country. But for the most of the world,
well, they do kind of run the world, definitely economically anyway.
For now, yeah.
They run the debt, For people to really understand, though, the cause of inflation would really, if you really get it, it's really simple, and it's really blows your mind, because people might think inflation is caused because ships haven't been able to dock and there's been a disruption to supply and the war happened, so that cut off energy coming out of Russia. They think of it all physically, but really what's sinister about this inflation is that the real cause of it was the Fed printing so much money to compensate for the disruption. So much so that they distorted the supply-demand shock 5 times what it would have been if they just left it.
Exactly right.
Or provided just a little bit of support.
Exactly right, that.
Like, the supply got jolted, but then they increased demand by 5 times GDP. Within the space of 2 years. So you cut off supply, you amp up demand. The real cause of China not being able to supply things is because people went crazy with spending online because they had so much money and they bought up everything and they wanted more. That there was a massive order flow that came into China still while they're recovering from COVID.
Yeah.
But then China had to try and keep up with like a massive peak in demand all of a sudden. It's like, whoa, where did that demand come from? Like,
and we first worked that out at the very start, because the narrative at the very start was the reason why we're having this inflation is because of supply chain disruptions. Oh, we're not getting stuff out of China. And then we went and looked at the actual containers that were coming in, and the container ports were processing more containers than they were before COVID.
Yeah.
So
the pretty much resumed to normal.
They were
like, magically.
Yeah. So now that recently in the last sort of 3 to 6 months, like inflation was already like 6-7% by the end of last year. But over the last 3 or 6 months, China has started this zero COVID policy, and that has actually now started to make things worse again. But at the start, it was caused by the demand and the too much money, and that's, as far as I can make out, totally undebatable.
Because you look at the reaction, if it was COVID that was the cause of inflation, the reaction at COVID, the drop in the stock market, in March 2020. Do we all remember that? That was the natural reaction to COVID.
Yeah.
That's a correction that needed to happen.
Exactly.
To come back down to reality and be like, all right, guys, let's all be like a little bit more sensible here.
Yeah.
Because we got something we're going to deal with now. It's going to be massive.
Yeah.
But then the Fed came out and pumped stimulus out, and everything recovered and everything shot to the moon.
Fed and every central bank, because that's the key point. Like, we're always saying the Fed, but when we say Fed, we mean like everyone, don't we? Like,
well, everyone
Reserve
follows
Bank.
The Fed.
Exactly right.
Basically.
Exactly right. Yeah.
In our westernized countries, anyway.
Yeah.
So they all follow, do the same thing. If they didn't do that, we had that correction already. We had that pullback in spending. The economy would have gone into a recession. But it's nothing compared to what we're going to face now.
Yeah. Yeah.
They just extended it, and then they've amped it up.
Exactly right. And they're trying to pull the reins now when every man and his dog knows how bad inflation is. They're seeing it in the supermarkets. They're going, wow, this is expensive. They've allowed it to get to a point, and up to a point where inflation, the actual CPI itself, the number is so bad that most people are using it to make future choices, and that's what's, still pretty crazy to think that the market is approaching this. It's like, oh, great, the Fed's serious about it. Oh, it's no problem anymore because they'll get it under control. Okay, they will get it under control. At this point, I've got no reason to doubt that Jay Powell has, he's a pretty old fella.
He keeps saying he knows that's what he's got to do.
He knows it's number one priority.
Don't hesitate to do that.
But we'll be required to do that. And how long a period of high interest rates? Will it be 2 years, 3 years, 4 years, 10 years? And adding to the fact that there are some what I'd call fundamental inflationary factors, like the deglobalization. I think that's a real thing. The fact that everything was made super efficiently and was running around the world, bits of everything were coming together to make every car.
Yeah.
And now we're having to actually, in each individual country, try and take more responsibility for the products that we used to just buy from overseas.
Mm-hmm.
And when you have to make that big change, humans are very adaptable, but anything new takes mining, education, human labor, capital, and about 5-10 years to get anything done that actually, like a factory, try and build a factory in 6 months. You can't. It takes time and, money. And that's why now, after the war in Ukraine, the EU, which is something Joseph Wang's talked about, the EU is now going to have a huge amount of borrowing that they're going to have to undergo to help to aid that country and, to boost their military spending and all these things. There's going to actually be a greater supply of debt coming into these markets than ever before. So there's still lots of great arguments on this is going to be around for a long time point of view, from what I can tell.
Yeah, we've been living in an age of prosperity massively.
Think about how much more it will cost to build any of the things. For example, a new port or a new highway or faster internet, anything that would be actually deflationary. Think about how much time and effort that's going to actually take in this inflationary environment to build something like that. Like, it's just going to be a nightmare. So the only solution, that's why the solution always comes back to just get the interest rates up higher than the inflation rate, because then you'll suck money out of the economy trying to buy cars, trying to buy food, trying to buy those kind of things, suck those things back into accounts because the returns are really good. And even though people can invest and can spend, they won't, because, you know, you can get 5% real return in the bank. But the effect that would have on assets, which are valued based on the money they produce, you know, when you can get 5% in the bank, you're going to want at least a 10% return as a yield from any property, because you can get 5% in the bank.
Why would you take a risk?
Why would you take a risk for, you know, it's a hassle being a landlord. You got to fix things, you know, you got to get a property manager. So it could come down by itself, but there's no historical precedent for that. So I'm very happy that we have been short as much as we have been.
Yes, me too.
And even when our option runs out in September, I think that unless rates have gone up drastically, I think we'll be probably rolling over into a new position of some kind. So we'll be cashing in a lot of the gains we've made. But I think definitely, I mean, do you agree with that? Like, do you think that that's what we should do? Like, I think that makes a lot of sense, because that historical...
Yeah, it's going to be a long-term thing. It's just crazy. It's dragged on for so long, like, when it was so clear so long ago. 6
months ago, it was 7%, you know? And people were thinking that 1.5% on the 10-year was a good deal. And now it's like 3.2 in 6 months, you know? So things can change fast. And it's gone from 1.5 or whatever it was to 3.2. Like, there's absolutely no law of economics that says it can't go from 3.2 to 6.4 in another 6 months. Yeah, the 10 or the 30 or whatever, they're pretty similar at the moment, but there's no rule that says that can't happen, because according to what we have, which is the inflation, that would make sense historically. So
I just think listening to Powell today, it's just like he really is serious about having to tackle inflation. Yeah. They're not going to, they're going to understand it's going to raise the unemployment rate. They're already starting to adjust what they're writing.
Exactly. The actual projections and stuff has changed so much in 6 months, eh?
So much.
Like, originally it was going to be 3 25 basis point hikes for the whole of 2022. Yes. Now, so that would be 75 basis points in a year. Okay, we just got 75 basis points in one month. Okay, and the unemployment rate they're forecasting has gone up a little bit. So they were originally forecasting 3.7, 3.9. Now they're forecasting 4.1. So it's going to go up a little bit. But the base interest rate they're forecasting has gone from 75 basis points for a full year to between 3.5% to 4% by 2023. So next year. Yeah. So by January next year, the consensus point of view is that they'll get the base rate to 4, So... Yeah, and what is it going to be by next meeting? Exactly.
And what about 3 meetings from now? It's going to be worse and worse and worse. As you said before, they're breaking it to us slowly.
Yeah.
But now they're having to quicken up because inflation is actually accelerating.
Yeah.
And that surprised them again.
They don't have the luxury of doing it slowly anymore. But
I just think, how the markets could respond positively after a Fed meeting like that is just bizarre. Just bizarre. I don't get it.
But it happens. That's the very funny thing. It happens after every Fed meeting.
I know.
I recall definitely at least 3 times where I've got the news on my phone in the middle of the night about what the rate hike was, and I've gone, that's more than everyone thought. And now I look at the stocks and they go up the day. Yeah. But if you look at it over a 6-month period, look at the S&P over the last 6 months. Look at the NASDAQ over the last 6 months. Look at the 30-year bond rate over the last 6 months. These things, it's a controlled demolition. Yes. Until inflation comes down, the demolition will continue, and they might want to slow it down sometimes or speed it up, but the trajectory is downwards until inflation comes down. It's like as simple as that, as far as I can tell. So, not financial advice.
No, no,
But
I wouldn't advise this to my worst enemy. No, I'm good now. I'm good now because for the past 2 months I've been chill.
yeah, but I'm the same though. Like, I'm not worrying about things as much as I used to. And I think that, ironically, investing is the only activity in life, I think, where the less you care about it, to a certain extent, in a certain way, the less you care about it, the better you are at it. Like, there's almost nothing like that in life, where, like, if you're a doctor who doesn't really care about the outcome, it's like, it's probably not a great doctor. But I think in investing, because there's so much you can't control, and because you're not actually in control of it, so getting like too much of a fixed idea in your mind of what you want to happen and what should be happening, and well, this is not happening the way I want it to be. Like, you know, Ramesh Prabhaya said that. He said that he thinks the perfect lifestyle for an investor is basically a gentleman of leisure.
Yeah.
And then, you know, when some crisis happen, you spring into action. And I feel like that's the only kind of investor that I am. Like, I'm not like a go through 1,000 companies kind of investor. I just like sit up there and just like look at the markets generally. And when I start to see something that doesn't make sense to me on a very deep level, like the fact that you have the third most expensive bank in the world, right, with the vast majority of its debt in mortgages in one of the most overvalued property markets in the world. So a bank is essentially just a holder of debt on assets, you know, pretty much. So it doesn't make sense to me that the Australian banks would be trading where they are. Like,
Yeah, well, it's just that kind of, they go back up, don't they, in the government, in a way. They might do, they might not. There's precedent for it now. It's like a little bit less risky than normal securities.
That's true. There is that element to it. But I read through the stress tests from 2 years ago, talking about like what the plan would be basically if house prices went down 30% and if unemployment went to 11%. And it basically, the plan was that based on the reserves the banks have, they're pretty solid. But part of the plan was to pay no dividends for 3 years.
Right.
So, yeah, the banks would survive if there's a property crash of 30%. But, you know, paying no dividends for 3 years, that's not the bank's in trouble. But that means the bank's worth way less, definitely, because that is...
But the banks will be in trouble.
I think they probably will be, but the good thing is about some of these situations, and the bond sure is the same. You know, we didn't need the rate to go up much to make our options go in the money. And I think with CBA, it's the same thing. It's like the price doesn't even have to decline very much. Like, they could still be one of the most expensive banks in the world, and, you know, shorting or buying puts would still make sense because, you know, once you get a 30 or 40% decline, you've made sort of a 3 or 4x usually, something like that. So,
yeah. And I guess people only hold them for the dividends.
Pretty much. I think that if we are going into a world where the commodity companies are really reliably profitable because you can't get a new mine built and they've got mines already running and the commodity prices are constantly rising, then we have a lot of commodity companies in Australia. So you could see a huge shift in capital from the huge banks and the financial institutions all the way over to like the big mining companies, where, you know, they'll be the ones who start paying solid dividends and start being, you know, reliable companies. Where, you know, if you've got the banks in Australia with house prices falling and not being able to do new loans because nobody wants to buy a house in a market where interest rates are going up and house prices are falling. I mean, who would buy a house in those sort of situations? So I think there's the potential there for that big money in super to start allocating away.
Isn't the ESG restriction kind of lifted now to make
pretty
energy
much
like a green option?
I saw that too. Yeah, there was
a while ago.
There was some change in some ESG policy to make certain kind of energy green. But you just need energy. You have to, keep people warm and stuff.
Yeah, it runs a society, doesn't it?
Yeah, you can't do anything without it. So as far as if we can produce it in a much, in a much cleaner way, that would be fantastic. We should do as much of that as we can, but you also can't take on huge amounts of debt right now to pay companies too much to do those projects, because that's going to be injecting money into the economy, So once inflation's really under control and there is like a lot of slack and there's a lot of people not working and things are calm again, then I think that would be the time to start a company that does renewable stuff and start to borrowing to invest and create the jobs that way. But at the moment, like with the inflation, that's if we don't solve the inflation, then we can't do anything.
No.
It's enemy number one, I reckon.
Yeah, and the market still hasn't got it.
Definitely not.
So, yeah, I just think it's bonkers. So I don't tune in. I just don't tune in anymore.
Good.
So yeah, I'd update Monish to a lady of leisure as well.
A lady of leisure. Oh, you're definitely a lady of leisure. That's for sure.
It's the way you got to do it, though.
I think so.
Stay sane.
I think, that should be, just like controlling inflation should be priority number one for the government and, the Federal Reserve. The priority number one for an investor, I reckon, in this kind of like situation, this kind of world we're living in, is to study as much Buddhism and yogic thinking as possible, because you have to stay calm and you have to stay rational and you have to stay happy. And if you're acting out of unhappiness in investing, if your portfolio moves downwards and you're feeling unhappy and you want to do something to fix that, there's probably nothing you can do about it. So you have to be okay with being happy and content with what you have, until an opportunity presents itself, which I think is the best way to be an investor.
You have to be, yeah.
You have to try and stay happy.
What you were saying before, how a doctor can't not care. That's opposite for an investor.
Yeah.
Because we're not dealing with lives here, we're dealing with money.
Exactly.
And what do you see money as? It's just a tool. So you should be trying to use it. But it's just a tool, so don't lose sight of that. You can take risk with it. And you shouldn't be just wanting to harness as much money as you can.
Definitely.
Just have money.
Yeah.
So you shouldn't be affected if you're up or down.
Exactly
it shouldn't
right.
affect your happiness.
Exactly right. Yeah. We were getting quite affected by the fact that our portfolio was potentially moving 10-15% in one day regularly. So that's hard for somebody who's got a little portfolio, but our portfolio is from when we sold our house. So it's not like a kind of range where it doesn't matter either way. It matters to what we can do with our business, and it matters what we can do with our future ideas that we have, the businesses we maybe want to start. It really matters. So we've got a lot of factors pulling on us to try and make us less rational. So the fact that you really have to have the approach where, I think you have to have the approach where you don't care whether you make money or you don't. You're doing something the best you can to be rational, and
you have to be okay with being wrong.
Maybe you're not a great investor, and that's okay, because being an investor is no better than being anything else. A carpenter, an investor, a doctor, they're just all things that people do. And if you're not enjoying the process, I love investing, but at some parts of this whole bond short, it has not been fun. And I think that the last few months, by taking it a bit less seriously and realizing that ultimately what we're playing with here is potential future activity. That's all money is. Money is just activity that you might be able to do in the future.
Stored potential.
Stored potential. We live in a country where if you lose all your money, you can get free healthcare from the government, you can get free food and free housing. So you're not in some slum, in the middle of nowhere, struggling to get breadcrumbs basically. Like, we're in a very privileged position, if you've got a little bit of money that you're investing and stuff and you're trying to compound. So I just think we need to take it all a bit less seriously. And when everyone's a bit more relaxed about the fact that they're losing or they're making money, then you'll get better choices made, I reckon, and you'll actually make better investments.
Definitely.
I think.
Because, well, we know that to be true for us anyway. Because, we couldn't have imagined the trade working out so well so quickly. It really took us by surprise. As soon as we started shorting in December, it's just been downward spiral for TLT.
Yeah.
If you look at that chart from December till now,
yeah,
it's the trades worked really well. And you think when that started working out, we would have been so happy.
Yeah.
And really, we were stressed.
Very
more
stressed.
than anything.
Yeah.
Because now we're thinking
geez.
Okay, probability is slightly adjusted now.
Yeah,
this
yeah.
is kind of a certain thing.
Yeah. And it's a big position. It's a
We'll
lot of
have
money.
to we'll have to reallocate quite a chunk, if this does keep going.
Exactly.
And it just stresses you out. You don't we should have been happy at that point.
I know.
But we were okay, what are we gonna do? We're gonna look into other investments now. How are we gonna it just raises the bar and you never quite reach that point that you start out wanting.
Yeah.
Which is imagine if the trade worked out.
Exactly.
And it starts to work out and you don't have that moment. You want the next moment.
Exactly right.
So you just have to stop that. And the earlier you realise it, the better.
The fact that you're even alive is a complete fluke of the universe. All the billions of years that, we lived. Well, the billions of years, that we were not alive. And then now we're alive for 100 years, hopefully. That'd be great, 100 years. And then we're not going to be alive for I don't know how many billions of years, infinitely possibly, or whatever in the future. That's an incredible privilege to be conscious at the moment. And on top of that, the fact that you're even, you've learned enough and you're involved in this incredibly interesting activity called investing, where you can speculate and you can, put your viewpoint, into the world, and you can sort of use what you know and use what you understand to make decisions that can potentially, make money at a higher rate than you can just work for it. That's the whole point of it, investing, is that you can actually compound money and compound, stored energy so that you can just
live off of it.
Live off it basically, and then make things happen in the world and do things and help people and, but there's no pressure, no one's watching you saying you're failing or you're succeeding. The amount of people in history who have put their whole lives into growing a business only to get to 100 years old and to think, oh gosh, what a waste of my time. There's a lot of more important things in the world than money, that's for sure. And I do think it's good to remember that, and remembering that makes you a better investor.
Definitely.
Yeah, because when we first sold our house, I'm all right, we're taking our equity and I'm investing our money. I definitely
all our money.
All
pretty
that money.
much.
Yeah.
90% of it
was free for me to put into the markets, about 6 years ago. And looking back, that was not that much money, at the time, how things have gone. But I was tried really hard to build a portfolio. And I started with okay, let's find some great value investments, some, low price to book, some cheap companies, things that seem defensive, some Warren Buffett kind of companies. 15 stocks feels like a good number. I'll start with a 2% position. I'll double it when things improve. I'll be very tactical about things, And I would have been much, much better off if I just waited for the times when I saw something and I was like, that is so cheap, and just got that feeling of, being so motivated that I had to research something because it was such an incredible opportunity, And so having that mindset of I have to do something, I'm going to find companies, I'm going to create a portfolio, I'm going to force myself to do this, I think that worked against me. I think if I just relaxed and looked around me for opportunity and not tried so hard, I think it would have worked out better. And that's the way it's gone. Like, our best ideas, the COVID trade, the stocks we bought during COVID, a couple of big positions, before, Lavisa was a company that like I looked into and did a lot of research on and got right, felt very confident about that. And putting huge amounts or, 10%, 15%, 20% into the things I was the most confident in, would have been smarter to do. And I think it's what we're doing now with our portfolio. I think our portfolio is like pretty concentrated and it's very volatile. But what does the volatility mean? Like,
you can go that bit bigger with higher conviction.
Yeah.
You can go 20% if you've got a real high conviction case for something.
Yeah.
And you actually feel safer than having 10 1%ers that are like little bets.
Definitely. But every person's situation is different.
Yeah.
And that's not financial advice. That's what's worked for us and what I've learned like for myself. You pretty much agree it would have made more sense.
Yeah, I agree.
If you got this far, thank you so much for listening. We really hope you enjoyed the conversation.
Now, if you'd like to become my 22nd
Or my 43rd.
follower on Twitter, links are in the show notes below. Mitch, anything else?
Nothing to add.